U.S. stocks just pulled back from record highs after a chaotic weekend reignited tensions between the U.S. and Iran, putting fragile peace talks at risk, just as the fragile ceasefire is approaching its expiry. But Tom Lee still believes more record highs are ahead.
My next guest sees more records ahead as one big catalyst may be getting ready to mobilize, which is retail. I thought retail investors already were mobilized. Fundstrat's head of research, Tom Lee, is here. He's a CNBC contributor. It's great to have you here, Tom. What do you see going on here?
Well, I think that investors got very cautious into the buildup of the war, and they were getting cautious because many stocks held by retail were getting hit, the software stocks. And as that fell, we know there were record inflows into software. And of course, the Mag 7 had been falling. So I think investors viewed the war and the start of the war as a time to take risk off the table, which was very different than what we saw a year ago when investors were buying into the tariff flows. And now I think that the downside tail risks have been removed for the war. Hedge funds have been early and they've been adding risk, and that we can confirm that from talking to our clients. And I think now it's retail investors that are now beginning to take money off the sidelines and buy stocks.
Maybe this is a psychological or a political question. I'm just curious if you have any insight as to why they would react differently to the Iran war versus not just tariffs, but anything else politically that's happened. I mean, buy the dips has become a well-known catchphrase. So it's surprising that they were, you think, kind of going the other way this time.
It is surprising. I was quite surprised because I would have assumed if someone asked me in 2026, a war is going to start, what will retail do? I would assume that they'd buy the dip. But in our surveys with our clients, we found that many maybe had policy puzzlement. They didn't really know how big this war could become. Their biggest fear was gasoline spiking and we could get a recession or a depression, and a lot of economists warned of that. So I think it was difficult for investors to say, we can trust what the administration's doing because there were too many people warning about the tail risks of that.
Tom Lee then says we could be entering one of the strongest periods for stocks over the next 18 to 24 months.
So that could be accounting. We could get both earnings and multiple expansion this year?
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in the market. It's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.